been doing this for 22 and a half years, and I try to tell the audience I started when I was 10. I'm the Doogie Howser of tax, but usually that doesn't work, and most of these people don't know who Doogie Howser is anymore. So whatever.
I have no idea who that is.
I figured.
We're the old guys, Chris.
What I'm looking for in a cost segregation study is a minimum, this is like bare bones, 5x. Meaning if the cost segregation study is going to cost you $3,000, which is a lower end one, I want at least a $15,000 immediate tax reduction. How do I get that? Well, if you're in the 25% marginal tax bracket, I've got to have a $60,000 deduction. How do I get a $60,000 deduction? Well, when I would need at least a 24% of the property. You need about a $300,000 property with 100% bonus depreciation, about a $500,000, $600,000 at a 40%. So it just depends. We work the math backwards to figure it out.
Do you think that bonus depreciation 100% is going to come back?
I do. The reason is that we had a bill go through the House last January 31, 2024. It went to the Senate. And no one wanted to play nice because we had an election year and it stalled in August. But we had bipartisan support to get 100% bonus depreciation. So I think it will come back. I don't know that it'll go retro to 24, but I think for 25 we'll get it. Now, as a tax planner, it's challenging, right? Because I've got a plan on 40%, but if it's 100%, it makes my life a little easier.
Welcome to the Cashflow Legendz podcast with your hosts, Nate, Brandon, and Brock. Remember, our insights are not direct financial advice, so consult with your financial team before making any decisions based on the topics discussed in this show.
Welcome back to Cashflow Legendz, where we teach you how to keep more of the money that you make so you can earn more on what you keep with as much certainty. We are excited today, fired up that we get to talk about something that most people would say is not a very fun topic, but I think we're going to have a lot of fun with it. And so Brandon's actually out at the beach with his family this week. So it's just me and Brock and our awesome guest, Chris Picciurro. So Brock, why don't you go ahead and introduce Chris?
Yeah, thanks, Nate. I'm so excited to introduce Chris. Chris and I go back, I would say 5 or 6 years now, which is awesome, and work together on a lot of different things. Chris is a wealth of knowledge when it comes to taxes. I'm excited to talk about taxes. I love taxes. I don't actually love paying the taxes, but I love talking about taxes. I actually hate taxes with a vengeance. That's why we do so much to not pay them legally and ethically. And so, Chris, I'm excited to get into our conversation today.
Well, it's an honor to be on the show. I'm a fan of the show. Thank you so much for having me. And I don't drink sweet tea, so I don't have sweet tea by my side, but I do have a caffeinated drink, and I'm ready to roll here.
We may have to change that because I don't think any of us drink sweet tea. During the show, I drink coffee, so put it that way.
I definitely drink water during the show. But Chris, why don't you kind of give us a little background of your experience within the tax world, because it's extensive and it's really good to know.
Well, thank you for this opportunity again. Thank you for saying my experience is extensive instead of just calling me old. So that's pretty cool. I'll take that.
I've gotten good at that.
When I'm doing a presentation or speaking engagement, it goes on the screen that I've been doing this for 22 and a half years. And I try to tell the audience I started when I was 10. I'm the Doogie Howser of tax, but usually that doesn't work. And most of these people don't know who Doogie Howser is anymore. So whatever.
I have no idea who that is.
I figured.
We're the old guys, Chris.
Pardon?
I said we're the old guys.
Yeah, exactly. I know. So by education, I am a CPA, and I've been owner of a CPA firm for, like I said, over 20 years. My role now is a tax planner, and tax strategist. And ultimately, Brock, you hit the nail on the head. What I do is I work with people to legally and ethically reduce the tax they pay in their lifetime, not just today. One of the big misconceptions about tax planning and strategy is that everything needs to be focused on the current year, and not enough is focused on future years or tax-free income and growth. It's not all about tax deferral and immediate tax reduction. Tax strategies need to, I always say that, tax strategies don't like to be single. They like to mingle. They like to jingle. They like to be blended and stacked together. So that's something to consider. But we're in this world now with tax planning and strategy that there is a lot more out there. And unfortunately, many people are getting their advice from TikTok and Instagram. And, we have a TikTok account, which I don't really go on because like I said, that's just not my jam. Like some other areas of social media, but we've had TikTok videos talking about a tax extension or something kind of maybe taken out of context that have hit a couple 100,000 watches. And I'm like, that's nothing. Why do people care about this? So, but it's a good reminder. Ideas are cheap. Implementation is very valuable. So so I've been working as a tax planner, tax strategist. And over the last decade, we've transitioned our private CPA firm to really be focused and leading with tax planning and advisory, obviously helping taxpayers with tax compliance needs, meaning tax preparation and that sort of stuff. But ultimately, the way I explain it sometimes is that, let's say you're trying to sell a house. I'm not your realtor that's going to sell the house. I'm going to stage that house. And there's nothing unethical with staging a house. Sometimes staging a house is, instead of someone walking into an empty house, let's rent some furniture. Let's make it look a certain way. Sometimes staging a house is, you know what? My kitchen's dated. I've got to put $20,000 into this kitchen, but it's going to fetch me $50,000 when I sell it. It's going to take a little more time. However, that's going to be a good investment. So I'm basically making your tax return, within the rules, manipulating the numbers on your tax return before they hit that tax return. There are some tax strategies you can deploy after the end of the year, but the vast majority of them you want to be doing throughout the year.
Yeah. Well, Chris, I think you did not mention this, but I think it speaks volumes about what you do and your expertise. I think you're on the board, or you're a large speaker with a company called like Intuit or something. Can you speak to that a little bit?
Yeah, absolutely. I've been very blessed and fortunate to been given the opportunity to share my knowledge and my experience. And quite frankly, Brock, we're big sports people, and I've tried to take this mentality that you don't lose. We win and we learn. And unfortunately or fortunately, I've learned a lot, right? Because I've been in business a long time, so I've failed forward a lot. And so what I try to do is I try to help other tax professionals lead with tax advisory, and through through the process of doing it in our own practice, we've been recognized by Intuit. I'm very fortunate to be one of the instructors for the National Association of Tax Professionals, and get to bring what we do to the tax community. And it's always great to speak to clients, investors, taxpayers, but when you can go peer to peer, that's special, and I think that forces you to become a master of your craft. I can talk about tax planning to 100, dentists, doctors, general contractors. Quite frankly, they're not going to know if I know what I'm talking about or not. But if I have to present to my peers and make it in a continuing education platform and format, then I've got to be on my game. So, and luckily with what we're doing with tax planning and strategy, we've developed some proprietary systems and processes that are scalable and adaptable for other firms. That's the big challenge, in the CPA world, is that we've got, according to a survey by the American Institute of CPAs, we have 75% of CPAs are leaving the profession in the next 15 years. That's scary. And if you're a CPA in business right now, it sounds good. It's really not good. So we have what's called a retirement cliff. We also have something called a pipeline issue. What that means is that we have a third less people even sitting for the CPA exam than we did 20 years ago. So there are some things that we're working on as an industry to get more people into the industry, to make accounting and part of STEM, even at the elementary, middle, and high school levels. So I advocate with many organizations like the Tennessee Society of CPAs, Michigan Association of CPAs, and that sort of thing, to get that going. So I know that was a long-winded answer. So yes, but I've been very fortunate to be able to present. But ultimately, and you guys probably know this, if you get the opportunity to speak to 400 of your peers at one time, the secret is, and I hope they listen to this, but if they're not listening, I'm gonna kind of chuckle at it. I learn way more from them than they're going to learn from me, and we learn more from each other.
I love how humble you are, Chris. Thanks. Well, there's a lot of tax things that we could talk about today. So why don't we dive in a little bit, and I'll get us started here. And I think one of the things that you probably hear it more than I do, but I know Nate and I hear it all the time. We had a meeting just a couple weeks ago about this very thing, and you probably already know what I'm about to ask, which is having a married couple and one being a W-2 employee and having a larger W-2. The advice that they've always gotten has always been, oh, well, you make a lot of income, so you're just going to have to pay a lot of tax. But with the tax code, there's actually ways that you can help this to where you don't have to just be a person who listens to that advice and just takes it. You can actually take what's called real estate professional status. So maybe we can dive in a little snippet about, hey, if you're a W-2 employee and you have a spouse and you guys are involved in real estate or want to be involved in real estate, how can this status, what does it actually mean? Like, do you have to actually get a license to be a real estate professional? How can this affect their tax situation moving forward?
Right. That's a really good question. Before I answer that, I'm gonna mention something when it comes to tax planning and strategy, because this plays right into what I'm going to talk about. We've developed something called Teaching Tax Flow, which is our proprietary tax planning and strategy process. Unlike the 10 commandments, we only have 3 laws we live by, right? So these 3 laws dictate how we do tax planning and strategy. The first law is that tax flow and cash flow are completely different things, right? Just like so if you sell a property, whatever you get at closing is not necessarily related to how much taxable income you have. That's just one example. And there's countless examples, but ultimately, what you have in your bank account at the end of the year is not necessarily your profit if you're a business owner. These are just little examples of cash flow versus tax flow. Second one, your tax return, and this is what you're talking about, is a verb, not a noun. Okay. Your tax return is a verb, not a noun. It's something that's a living, breathing thing that's happening throughout the year. If you have that mentality that your tax return's a noun, then it's something that gets done. There's no proactivity. A tax return is just a scorecard of all of the things you did, all of the activities that you partook in, all the strategy or lack of strategy that you did from the year before. The third one, which I'm going to tie into the rep status, is that tax agencies are your involuntary business partner. We have them. Now, luckily, I live in the state of Tennessee. Brock, I know you're in the state of Tennessee. Nate, you're in the state of Texas. So we don't have a state income tax. Now we have a franchise and excise tax. So in Texas, there's that. We don't have so the IRS is our business partner. And just like any business, when you are a partnership, you have an operating agreement. The operating agreement dictates who gets what, who can do what percent of the profit, what percent of the distributions goes where. If you don't write your own operating agreement, meaning you don't do any tax planning, the IRS writes your operating agreement. If you want to write your own operating agreement, you can. The IRS will then be a limited partner and you're the general partner. So you've got to decide how you're going to play your cards when it comes to the tax code. So we know tax agencies are involuntary business partner, which means tax laws are written. Let's think about this, everyone listening, to encourage or discourage certain behavior. That behavior could be economic, financial, social. There's a lot of different things out there that the government wants us to do or is rewarding us by doing through the tax code. So real estate professional status. Let's talk about that. In 1986, a couple things, guys. Guess what? I was a paper boy slinging Detroit newspapers and riding a bike around the ice storms. I was only 11 years old. My first shot at entrepreneurship. That's a story for another episode. But back in 1986, the tax law changed. And real estate rental property went from being an active to a passive activity. So a passive activity, if you are a high W-2 person, losses generated from passive activities like a rental property are not deductible. They just carry forward as passive losses until you either sell the property or you have some type of passive income. How do we not treat rental properties as passive? Well, by making them non-passive. Wow, gosh, this guy sounds pretty smart. That's really complicated. I know. How is something non-passive? If your real estate professional status, what you mentioned, Brock, rep status. How do you become rep status? It's a year-by-year test. You have to have 750 hours into real estate trades or businesses, and it has to make up more than 50% of your professional time. Now, anyone that is a parent, anyone that is a homemaker, knows a homemaker, understands being a homemaker is a lot harder than going to work. I've only done it temporarily, and then my wife fired me when she went away with friends or something for a few days. So even though homemaker is a very difficult job, it doesn't count against your professional hours. So in the fact pattern you're laying out, a strategy that a lot of people take is they will have that high W-2 earner here. The spouse would be on the other side of things. They file together. The spouse gets into real estate and obtains real estate professional status, rep status. Now the any rental properties they own, that activity is considered non-passive. And then you pair that with a strategy called a cost segregation study to accelerate depreciation on those rental properties and offset the W-2 wages. So to get that non-passive treatment, you need rep status with something called material participation, or you can potentially own and operate your own short-term rental properties. So many people listening have probably heard of the short-term rental loophole, STR loophole. I know we have all these acronyms in the tax code, in the tax world, to get that non-passive treatment of rental property. Here's a couple nuggets on that. It's a year-by-year test. And the beautiful thing is, Brock, let's pretend that you have a client that is a doctor. The client, and she is the second in charge of Vanderbilt Hospital, making boatloads of money, surgeon, et cetera, et cetera. First of all, your client, nice job in the marriage game. Okay, now your client here is a homemaker. But let's say he wants to get into flipping houses and buying rental properties, and let's say he's doing something called BRRRR, which is a strategy where you basically rehab and pull the equity out and do it over and over again. And he meets real estate professional status. Well, let's say they bought these rental properties over the course of the last 4 years, and he really wasn't doing it full time. But then he decides, I'm going in 100% into this real estate game. So in 2025, he is rep status. They've only used straight line depreciation for these rental properties for the last 5 years. He can actually run a cost segregation study on a property purchased in 2021 and count it in 2025 if you're rep status. It's a get out of jail free card. Now, for those that play Monopoly, no one will play Monopoly with me anymore because I tend to be a nice guy, but I'm a real jerk when it comes to Monopoly. So I call it the get out of jail free card. So using the rep status paired with the cost segregation study means that is great. So when we're working with a new potential client or reviewing tax returns for someone, and we see that they could meet the short-term rental loophole or rep status in a year, and they have not ever done a cost segregation study, we call scrubbing their depreciation schedule and looking for those opportunities. So I know we just talked about one strategy for a little while, but that's just kind of how tax planners think.
Mm-hmm. Yeah, I think that's fantastic. Nate, do you have anything that you want to add there before I jump back in?
Go ahead. I've got something, but I'm going to wait.
Okay. So, Chris, a lot of people have probably heard about cost segregation study, how this creates bonus depreciation. Before I ask about what's going on in the news right now, could you give a little blurb of, hey, here's some guidelines you want to look for on whether you should take this depreciation, this cost segregation? Like, when should you partake in it?
Absolutely. You should. There's a couple reasons you would want to do. Let's take us up with cost segregation study. What you're doing is you are breaking out the personal property portion. I know that's a that's a mouthful, of your real estate. Real estate's depreciated over a straight line basis, which is confusing anyway, because if you invest in real estate, you don't think it depreciates, it appreciates. But when
And Chris, real quick. So that big kind of funny acronym or words that you just put together, just to put that in layman's terms, that's like you walk into a building and you realize, oh, wait a second, the windows only have a lifelong of this, the ceiling tiles have a lifelong of this, the carpet, the floors, and you're pulling all of that together to then pair it up with the building's straight line depreciation.
Correct. So like a commercial building is a 39-year asset. So you're going to depreciate that over 39 years straight line, meaning you get an equal deduction every year. But if you walk in and you have landscaping, windows, electrical system, um, heating and cooling system, all those things could be broken out into 15, 7, or 5-year asset classes. And with the Tax Cuts and Jobs Act of 2017, be eligible for bonus depreciation. And the bonus depreciation is based on the year the asset was placed into service, not the year your rep status. That's why I'm saying, an asset placed in 2022 still gets 100% bonus depreciation, even though we're in 40% right now in 2025. So then, now it gets tricky. So if you've used straight line and now you're going to use the bonus depreciation this year, in 25, then you have to do, I'm not going to get too technical, but you have to do a change of accounting method, form 3115, and make what's called a 481A adjustment. So you can go to the IRS and say, we're changing our accounting method. We're changing how we depreciate this asset. And it's an automatic stamp of approval by the IRS if we do it the right way. So that's the nice part. And in general, rule of thumb is going to be most buildings are about a 24% of the building in general is going to be personal property, eligible for bonus depreciation. Now, when we look at mobile home parks, those type of asset classes, it's going to be a much higher percentage because all of the landscaping, all of that, a lot of that infrastructure is actually considered a 15-year asset, which is eligible for bonus depreciation. So yeah. Now, when would you do this? A couple different situations. Teaching tax flow, we teach people that you diagnose, then you prescribe, meaning figure out what your marginal tax rate is. And if you are at a high marginal tax rate, what we call a red diagnosis, then a cost segregation study makes sense. Well, I just had a client, super intelligent. He operates double-digit short-term rental properties and also co-hosts properties for other people. His mom owns a short-term rental property. Her CPA was like, yeah, you should do this cost seg. I've heard of it. He sent me her tax return. She was going to save like $5,000 for a $80,000 deduction. She didn't have much income. So why do the cost seg? That doesn't make any sense. So when you do it, one, if you are in a high marginal tax rate, and your rep status, or your short-term rental property loophole qualified, or let's say you have passive activity income. So some people might have a building that's paid off, just cranking cash to them and paying tax on it. They can go, let's say they're a passive investor, so they're not rep status or STR, short-term rental loophole. They can go take that other building, do the cost seg and offset it. What if you have a portfolio of 4 properties and you have you sell one? You have a huge gain. You didn't do a 1031 exchange. Well, you can group these with passive activity. That's kind of like what we call a poor man's or poor woman's 1031 exchange. You go do a cost seg on another property. So you've got to diagnose and prescribe.
That's right. Now, is there like if I was to think through this of like, hey, you know what? Well, I have this property, but it's worth $100,000. Is there like a dollar amount or a value amount that we should be looking out for as it pertains to these properties?
Correct. I would say, and I'm going to throw in one more situation where the cost seg might make sense. Let's say you have a really nice cash flowing property and you are a high marginal tax rate, even if you're passive. Let's say you're that doctor, that sugar mama that this guy married, and she's, you're in a 40% marginal tax rate and you're in California. And it's probably more than 40%, but we won't pick. We pick on California in our podcast enough. I won't pick on them here in this one. But let's say you're 40% marginal tax rate. let's say the rental property is cranking them, $10,000 a year of taxable income, even after straight line depreciation. They're losing 40% of that to tax. So they might want to do the cost seg just to get tax-free income and growth. Just to say, if I told you, hey, you're going to get an 8-9% return on an asset tax-free for the next 10 to 11 years, that sounds good. That's all so create that passive loss on purpose. So I just would be remiss if I didn't mention that strategy. So, when does
We talk a lot about that with our cash flow engines, right? When in our process, we want to take the money that's left over, our net cash flow, and bring it over to what we call cash flow engines, which are things that produce income, tax more efficiently than our paycheck. And the more times that we build that cash flow momentum, the more we can alleviate the financial gravity or the financial pressures on our paychecks, and we can reach financial freedom faster. So I think that's a great point there, Chris.
Yes. Well, thank you. I'm going to pat myself on the back later.
Chris,
So when do we do it? Well, obviously with bonus depreciation at 40% as we record this, it stops, it doesn't make sense as much as it used to. That being said, what I'm looking for in a cost segregation study is a minimum. This is like bare bones 5x, meaning if the cost segregation study is going to cost you $3,000, which is a lower end one, I want at least a $15,000 immediate tax reduction. How do I get that? Well, if you're in the 25% marginal tax bracket, I've got to have a $60,000 deduction. How do I get a $60,000 deduction? Well, when I would need at least 24% of the property, you need about a $300,000 property with 100% bonus depreciation, about a $500,000, $600,000 at a 40%. So it just depends. We work the math backwards to figure it out. So I'm saying $500,000 or more, I would start considering it in this environment. But when we had 100% bonus depreciation, $300,000. And typically what's going to happen is if you have a property that's $1 million or more, you require a site visit by someone that performs a cost segregation study. If it's $1 million, if it's less than $1 million, you could typically find a firm to do that cost segregation study using property tax records, satellite images. Sometimes because you got to think about that audit risk is much less at under $1 million.
That's right. Do you think that bonus depreciation 100% is going to come back?
I do. The reason is that we had a bill go through the House last January 31, 2024. It went to the Senate, and no one wanted to play nice because we had an election year, and it stalled in August. But we had bipartisan support to get 100% bonus depreciation. So I think it will come back. I don't know that it'll go retro to 24, but I think for 25 we'll get it. Now, as a tax planner, it's challenging, right? Because I've got a plan on 40%, but if it's 100%, it makes my life a little easier.
Chris, as I've been listening to you share, I have no doubt there's going to be people listening going, why hasn't my CPA told me about any of this stuff? We have real estate investors who listen to the show. What is it that has caused you to separate or elevate yourself above the standard CPA?
Well, I would say that I have an awesome team, right? Because if I couldn't get out there and focus on tax planning and strategy, if we didn't have what we call the kitchen, behind the curtain, the back of the house, that is really, really talented and great at working on our tax compliance work that we do. And I mean, our administrative team is amazing also. So that has helped me do this. Now, the other thing is I've typically been an early adapter into looking forward. So, 12 years ago, we made a shift to say, I'm going to lead with this tax planning and strategy. We're going to go to a subscription-based model for our CPA firm. And it just forced me to hone in on this tax planning and strategy. Why don't most CPAs do it? Because the reason is, one, we're losing a lot of people in the profession. We have a very tough situation with April 15th being what I call a fictitious deadline, but it is a deadline for at least filing an extension. tax documents now are not even coming out till March. So you've got a shrunken, tax quote unquote filing season. And then CPAs in general, like they're really talented. So typically the evolution is going to be, okay, I'm a CPA, I'm an enrolled agent or tax professional. I work at a firm. I'm making a decent living. Why am I doing $300,000, $400,000 worth of billable work and I'm getting paid $100,000? Something's wrong. Okay, I'll just go off on my own. So you go off on your own, but you have absolutely no entrepreneurial skills. You don't know how to run a practice. You don't know how to use technology. You don't know anything on how to do this. So you're constantly chasing your tail, and you go off on your own and you start being what we call. And so I have my own mastermind group for tax professionals and some coaching and stuff. So some of these terms I use there, but you become a price taker, not a price maker. And you take whatever you can get to get the ball rolling, to keep the lights on. And then you kind of lasso your way into a relationship where you can never really charge for your value. You really only have one chance to show your value, and that's at the beginning of the relationship. So now they don't have the margins to hire anyone. It's this whole big cycle that they go through. So they can never really look forward. They're completely burnt out, and it's a mentality that you have to change. That's that whole, your taxes are a verb and your tax return's a verb, not a noun. So yeah, and it's just a cultural thing. It's like we have not used a timesheet in over 12 years. We don't believe in timesheets. We don't believe in charging by an hour, 6-minute increment, 50. What does it matter, Nate, if you call and you jump into what we have, CPA urgent care for our clients,
which is awesome and everybody loves.
Oh, thank you. I appreciate that. Let's say you want to sell a property and you want to know how much it would cost if you sell it versus a 1031 exchange. Does it really matter if it takes us an hour or 10 hours? Why should you get penalized if you've got a new person that doesn't know what they're doing and it's going to take them 10 hours? So yeah, that's why, and it's interesting. I'm sorry. And I'm always trying to figure that out myself, because I'm trying to get people to, it's hard sometimes. I always tell the accountants, like, it's easier to turn a motorcycle around than an 18-wheeler. And, a lot of times the other option is someone goes off on their own and they buy a practice, right? And now they just bought a bunch of legacy issues, but it's a security blanket that they have cash flow, but it's not good cash flow. And this is the God's honest truth. In the last year, I've had 2 opportunities that people were going to give me their practice. They were done. They were just, you guys can have my whole book of business. And we said no for free, because I just don't. Now I'm inheriting all those issues, we'll say. Yeah.
I've gotta throw this in there because recently on your show, Teaching Tax Flow, you had a colleague of ours. So Brandon and I are authorized practitioners through the Nelson Nash Institute, and you had an IBC practitioner named Tom Lawn on there, or Lonnie, however you pronounce. But just for people who are listening from a CPA's perspective, can you just speak briefly on just the value of having a whole life strategy in your life?
Absolutely. I mean, my wife and I have a whole life policies. We've used infinite banking for about 6 or 7 years, I want to say. And that comes down to tax-free income and growth. So that's our gold diagnosis. I feel like everyone's a gold diagnosis, and gold diagnosis and teaching tax flow is the most underused. So what's gold? Roth IRAs, 529 plans, advanced life insurance planning, or cash value of whole life insurance. However we want to say it. So I think it's very, very important, and I encourage our clients to understand that not all tax planning has to happen in year one, and not all tax planning has to be tax deferral, like I think I might have mentioned earlier. I can speak for myself. When we bought our first short-term rental property in Panama City Beach, and it was a long time ago, not too, decent amount of time ago, where you can buy it for $212,000 for a nice income 2-bedroom condo that was income producing at a Slate View. Well, at that time, it was right before the pandemic, that time frame. banks were getting tighter. It was a non-qualified property. And I was like, why don't we just use cash and pay for this property? And we ended up buying it, and then we bird it, meaning we pulled equity out of it. We were able to pull, I think, 70% of the equity out of it after 6 months, put it back into the policy, and then we were rolling again. So cash, we say in our industry, capacity is power and cash is power. Liquidity is power. So when you're a business owner, unfortunately, the other thing is, I've been in business for over 20 years. Banks look at us like we're some type of crook. And we have a lot of friends that are bankers. Why can someone that is a W-2 person at Nissan or Bridgestone or General Motors that could get fired tomorrow because they do something stupid in the park or just do something really bad? Why are they a lower risk than someone that's been in business for X amount of years? But we seem to have a higher risk profile. So take that matter in your own hands. And there's a ton of tax advantages.
Mm-hmm. Chris, we're going to have to get you on for a part 2 because there is so much to talk about. But in these last couple of minutes and kind of how we wrap up, why don't you first cover, what are some low-hanging fruits that we should be looking out for within our tax planning to say, hey, if we haven't done these or we're not recognizing these, we should probably either talk to our accountant about them or come talk to you about them. And then how do we get in contact with you?
Absolutely. And yeah, so that's my strategy is I, make sure that I have a meeting after this. So you have to invite me back. So this, I would say the low hanging fruit is, first thing is figure out what your marginal tax rate is. So we can work through low marginal tax rate is going to be Roth IRAs, tax-free income and growth. That's pretty straightforward. I like Roth IRA. I like Roth conversions and Roth contributions. Those are especially, it kills me when you get a teacher that is my wife's a teacher, by the way, making a modest income that gets out of school. They don't know any better, and they start putting money into a tax deferred account to wipe out a 12% marginal tax rate. That just doesn't make any sense, right? So low hanging fruit is going to be your Roth accounts. I'd say the lowest hanging fruit for real estate people is a cost segregation study. Another one, health savings accounts. I used to kind of poo-poo them. They're very powerful in many ways. So if you're eligible for an HSA, that's a low hanging fruit. Those are going to be the HSA and the Roth are really basic tax strategies. The cost segregation study is what we call an advanced tax strategy, but it's still low hanging. And then also, I'd say for anyone paying $100,000 or more in tax, transferable tax credits or tax bonds are pretty low hanging also. They're not, and that they're pretty advanced strategies, but they're not. When I look at low hanging Brock as saying it's a transaction, it's a tax mitigation strategy. It's not, I'm going to invest in an oil and gas syndication that I'm going to own for 20 years. So, and nothing wrong with that. I'm just saying, it's about diagnose, prescribe. So those, to me, based on your income level, those are your other ones. I'll say one more. And I hate to say this because it's overused sometimes, but if you're self-employed and you have a significant amount of income shifting to either a spouse or potentially your children is pretty low hanging fruit also.
Right. I'm with you. Awesome. Well, Chris, how do people find you and learn more about you or sign up for Teaching Tax Flow?
Right. Well, thank you for that opportunity. A couple ways. I would recommend just going to 2025.tax. That's 2025.tax. You can submit an inquiry. If you've heard me on the show, which I'm sure there are thousands, maybe millions of people that will submit an inquiry. So thank you. We could sit down and have a 10 to 15 minute quick chat. Let me guide you in the right direction. The other thing, I'm going to invite all the listeners to our free private Facebook group. It's Defeating Taxes.
Which is awesome.
Thanks, Brock. It's Defeating Taxes. So you can go to defeatingtaxes.com, and we post once a week. We do Ask the CPA Friday. That'll give you a flavor of what we're doing. And then or jump on a Teaching Tax Flow's YouTube channel. We've been really putting a lot of our content on there, posting 1-minute quick tips almost daily, just to get people that idea. So I know I gave you 3 places, but that's where you can find us.
Awesome. Incredible, Chris. Today was awesome. Thank you so much.
Thank you, gentlemen. It was a pleasure, and I appreciate it.
Appreciate you.